The S&P finished above 6,000 for the first time in a while, and it is knocking on the door of all-time highs. I believe it's around 6144 or so. Cryptocurrencies, Bitcoin is at 107, fluctuating near all-time highs. I think 109, I want to say 225 is the all-time high for Bitcoin. Now, guys, there are trade talks going on in London between US and China, and of course, everyone is going to center their short-term focus on that. But remember, what we try to teach everybody is in the short run, none of the fundamentals matter. In the short run, it's just what's popular, what's not popular is going to go up and down, and that's just it. And if you think otherwise, it's probably misguided there. You know, I saw recently that a bank was altering their short-term S&P based on the fundamentals. Guys, you'll find it very interesting. When the S&P goes down, banks will start modifying their year-end targets to the lower side. When S&P is going up, higher side. And these are the same people who are going to tell you that they're long-term thinkers. The true long-term thinkers will never, ever, ever make a short-term assessment on where stock prices are going to go. These are the Warren Buffetts, the Howard Marks, any of these guys. They'll never, ever say that. Why? Because in the short run, stocks are a voting machine. In the long run, they're a weighing machine. We're trying to teach this principle-driven approach. Principle-driven approach. In the long run, valuations. We talk about this constantly. Stock market to GDP ratio, the most reliable metric at any given time on where valuations stand. Guys, we're 105% overvalued. That's very overvalued. With that said, I want everybody to look back. Our fair value today is 2921. In 2022, fair value was 2400. We were 80% overvalued. Now we're 105. The point is, in the short run, we don't know what's going to happen. And if you made decisions based on this in the short run, you got killed here. Well, you didn't get killed. You missed up on upside. Now, 2,900, that sounds pretty low. It is low. And there's a lot of arguments to why this fundamental metric, which is reliable to the tune of a negative 0.82 correlation. For those of you who don't know what this means, this correlations go between -1 and 1. Negative 0.82 means the higher valuations are, the lower returns are, and it's a very, very, very strong correlation of that. All that means is in the next 10 years, it's going to be a rough go. Doesn't mean you can't make money. It just means be ready for this. A lot of volatility. Because it's easier for stocks to go down in price than fundamentals to go up. Is it easier for a stock to fall in half, or is it easier for their profit and free cash flow to double? I think it's pretty obvious there. You look at any stock, look at their fluctuations any given year. Look at Tesla. Look at NVIDIA. NVIDIA was a high of 153, hit like 86, and now it's back at 140 or some gibberish like that. This is all in the last 3 to 6 months. Guys, this is a multi-trillion-dollar business. It's much, much easier for stocks to fall in price than it is for fundamentals to get better. But that doesn't mean, the reason we bring this up is it doesn't mean you should sell. What it means is be ready when the short-term stock market gives you a buying opportunity, when price is below value. That's all value investing is price being below value. That's it. That's all investing. Now, when you want to base your fundamentals on earnings, this is the 10-year earnings of the S&P. It takes all the last 10 years, brings it to today, and then says, what's our ratio? Guys, we're 37 times earnings. Historical average is 17. So we're 114% overvalued. That's a big number, guys. 114% overvalued. That puts fair value at 2,800 or so. The two most reliable metrics are probably right here, these last two I talked about, and they're both saying that fair value in the S&P is the high 2,000s, maybe 3,000. Now, can I understand a higher valuation for stocks today than 50 years ago? Of course I can. We're going to have a billion-dollar company someday that is run by a couple of people. Every single year, we get more and more companies that are getting bigger and bigger on less people. I saw something. The U.S. has the most companies valued at over $100 billion. There's 100 companies valued over $100 billion in the U.S. That's insane. That's what we're trying to say is, in the long run, bet on the U.S. In the long run, if you make that bet, you're probably going to do pretty well. In the long run, if you bet on the world economy getting bigger, you're probably going to do okay. The key is the less you pay, the better you will do. And that's why we're teaching this fundamental approach of dollar cost averaging along the way. Don't try to guess where we are. You don't need, you can be, I was thinking about it this weekend. I was at home and I was thinking about investing and I was looking at my numbers. I do my numbers all the time to see what I need to, my goals in investing have changed a lot because of all the things I have going on. I have real estate. I have apartment buildings. I have single family homes that I rent out. I have businesses. I have a lot of great things going on. And I look at the numbers going, if I just made 10% a year overall, I would be massively, and I thought to myself, okay, well, I'm also starting with a bigger nest egg. But then I thought, well, wait a second. If I'm 25 years old and able to save 6 to 10 grand a year, I would be very, very wealthy at the age of 65, making 10% per year. You don't have to make 15, 20% a year. Don't go for those home runs. Dollar cost average. And if you want to learn a great process, a principle-driven approach to buying individual companies that'll help you take advantage of opportunities, that happens here. That happens in the stomach. Now, guys, I'm sure a lot of this is ringing true to you, especially if you've made it this far in the video. There is no magic bullet to investing. It's all about how you approach it, how you look at it, how you think about it. The numbers are the easy part. I can teach you that in a matter of seconds. Not seconds, but you'll learn the numbers very easily. The hard part is to sit there and keep the noise out. Sit there and realize that US-China trade talks in London have no bearing on the long-term effects of the stock market. Realizing that interest rates have no long-term effect on stock market. Look at it this way. In 2022, we had interest rates at near zero. Now they're at 4.5%. That was supposed to be the big dagger for valuations. That was going to take the stock market plummeting down. And we had a bear market in 2022 and then all-time highs. It didn't really do what everybody thought. Now, is that a lingering approach to it? Yeah, I mean, at the end of the day, if you can make 4.5% of your money by investing in a 10-year treasury, based on where we are with the future potential of the stock market, the next 10 years, the 10-year treasury might very well outperform. Because look at this. When we're 50% or more overvalued, 398 quarters going back to like 1900, 31 of them are 50% or more overvalued. The average is a negative 2.3% return without dividends. So maybe call it even with dividends. But here's crazy, guys. This is a 50% overvalued. We're at 105. And as you can tell, the more and more undervalued and overvalued you get, the returns follow. It's not a coincidence. So the next 10 years, I'm willing to make this bet right now. I'm willing to bet buying a 10-year treasury today outperforms the stock market in the next 10 years. If you think that's crazy, subscribe to the channel. We'll see what happens in 10 years because this channel's been around for a long, long time. If you think I'm not crazy, subscribe to the channel. That's all I'm asking you to do. Thank you for your time.